Welcome back to UB Satish, where we dive deep into the Indian stock market. Today, we'll explore whether Indraprastha Gas Limited (IGL) is a hidden gem or just another victim of regulatory headwinds. With the stock down nearly 46% from its high, is this a golden opportunity or should investors stay cautious? Let's find out. IGL, a leading city gas distributor, has been hit hard by regulatory changes. The government has reduced domestic gas allocations from 70% to just 35%. As a result, IGL has to rely more on expensive imported LNG, nearly doubling its import costs. In response, IGL raised CNG prices by 1.5 rupees to 4 rupees per kg, except in Delhi, where elections are approaching. However, maintaining its EBITDA margin of 7 to 7.5% per standard cubic meter would require another 5 to 6 rupees price hike per kg. Despite the price hike, CNG still offers a cost advantage over petrol and diesel due to its 40 to 45% better fuel efficiency. While petrol costs 96 rupees per liter and diesel 86, CNG remains at 75 rupees per kg. Regulatory relief could come if the government reduces the 14% excise duty on CNG and cuts GST from 28% to 12 to 14%, similar to electric vehicles incentives. Talks are reportedly ongoing at senior ministry levels. Despite Delhi's push for electric cabs, CNG vehicles penetration has risen from 24 to 28%. Automakers like Maruti Suzuki, Hyundai, and Tata Motors continues expanding CNG offerings, ensuring sustainable demands. Here's a key IGL stock is trading at a P ratio of 14 x, much lower than its 10-year median of 23x. And with this is with no debt on its balance sheet and a 20% rebound from recent lows. Could this be a deep value play? It all depends on how well the company navigates these turbulent times. So, is Indraprastha Gas Limited a hidden gem or a risky bet? Let me know your thoughts in the comments. Don't forget to like, share, and subscribe for more in depth stock market analysis. See you next time on UB Satish.